Our next guest, listen to this, Jess. The next move the Federal Reserve will take may be a hike this fall. You don't see that every day, so that's where I want to start. Skyler Weinand joins us, CIO of Regan Capital Management, down at the Hedge Fund Hotel down in Dallas, Texas, the Crescent Court. Spent many a day there, got tons of II votes there, stayed at the hotel there. It's a good place to be. Skyler, talk to us about kind of how you're approaching the market these days. We've had that 10% pullback in the market, got people's attention. We bounced off that a little bit. Where do you think we go from here?
Long term, up, for sure. You know, it's going to be volatile, but what we're seeing is that the consumer and corporations in the U.S. are still so strong. Corporate leverage levels are the lowest they've been in recorded history at about 20%. And consumer balance sheets are extremely strong in aggregate. You're looking at $160 trillion of net wealth in the United States. A lot of that has come from the stock market and real estate. And so, you know, that spending is going to come. But for right now, you know, people are a little bit nervous. Corporate activity, corporate M&A are in the same boat as consumers. But long term, you know, we kind of see this market running for at least the next 3 to 4 years based on how much dry powder is available for consumers and corporations.
So you're thinking a potential hike maybe in the fall. I mean, what would need to happen in order for that to occur?
It's already happening, right? So look at inflation. Look at what was really interesting about the recent Fed meeting a week ago was not only, you know, the presser and what they did, but if you look at the dot plot, and if you look at their predictions, they make those predictions once a quarter of where GDP is going, where PCE is going, and where inflation is going. They're predicting PCE to actually, it moved up from December to March. And they're predicting that rates, you know, inflation is not going to fall below 2 for years, you know, 2+ years. They're predicting unemployment to actually fall. So unemployment's coming down, inflation's going up. Those are their two mandates, right? And so there is absolutely, no one can make any reasoning for me as to why they would hike in this environment, okay? Yes, financial conditions are restrictive. They're saying they're fairly restrictive right now. But if tariffs come to boot, and if that causes inflation, we're going to see another, you know, Paul Volcker type of moment where they're like, all right, we need to get this under control. We need to hike back up to, you know, 4.50 to 5%. So
given that backdrop here, we've gotten, I guess, a lot of noise that the markets have to deal with on a short-term basis with policy decisions coming out of Washington. Are we embracing risk in the equity markets? Are we embracing risk in the fixed income markets? Or are we kind of just holding back a little bit?
On the fixed income side, you still have to stay short. Okay. You know, the Fed cut last September, roughly 6 months ago. Fixed income has not done very well since then. The ag was up 1.25% last year. It's up about 2% so far this year. So the ag's done okay, but from September to today, it's down. Okay, so it's basically flat. So, and if you look at the shape of the curve, you're not getting paid. You know, you can sit there in cash at 4.30. You can buy agency government guaranteed mortgage bonds that are floating rate at 5.25. Okay, so you can get paid 5-handle yield to sit there, and the belly of the curve's inverted.
All right, stay with us. We're going to come right back. Thanks so much for joining us here. International. A lot of people are talking to me about international markets, and they've had such a good start, European markets in particular, this year. How do you guys think about the U.S. versus non-U.S. these days?
Well, part of that's due to the dollar. You know, the dollar's come down. If you look at Asia, for example, Asia's not done very well this year, but dollar adjusted it has. So that's part of it. But, you know, so that's helped out Europe a little bit. But, you know, Germany announces that they're going to turn the printers on and they're going to issue tons of debt. And going back to World War I, Germany is a very austere economy. Yep. And now all of a sudden, you know, based on the Ukraine war, all right, we're going to see a ton of debt printing. And so that's really ignited certain sectors, obviously like defense. So, yeah, it pays to be, you know, well diversified, both in terms of, you know, equities, but also in terms of locations as well.
How long does that story last for international, just because they underperformed so much relative to the last year, and especially the last 2 years of the bull market run and the S&P 500 because of what was going on with AI? And obviously these other corners were cheaper, but is this something more temporary? that you think is going to happen more internationally,
For sure.
or does it stick?
Yeah, so, we're a couple months into the administration, 2.5 months, right? And they came out, the administration came out and said, hey, look, we're going to break some things for the first 100 days. So what do we got? We're halfway there. We're halfway to 100 days, basically. So, 3-4 months into it, we got a couple months to go before the spotlight comes back on the United States and volatility decreases. We're seeing that in the VIX. VIX almost hit 16 handle yesterday. And so when that volatility subsides, I think the spotlight comes back onto the U.S. It comes back onto the big Mag 7, tech, AI, you name it.
30 seconds left. Earnings. What's your view on earnings? Can we depend upon earnings to drive this market?
No.
No.
So earnings will be there, but at a decreasing rate. Okay. So we've had a gangbuster 3 years, right? In, 2.5 years. So earnings will be coming down on a year-over-year basis. We can't continue to produce just gangbuster year-over-year earnings. And so, yeah, maybe the stock market ekes out 5-8% this year, but above and beyond that, seeing the 20+% that we saw the last few years, that's not going to happen.
Right. Very good. That's kind of what we've been hearing from a lot of folks, looking at an earnings growth rate or stock market return rate of kind of mid to high single digits, as opposed to the 20-25% we've seen over the last couple of years. Skyler Weinand, thank you so much for joining us. Skyler Weinand, he's the CIO, Regan Capital Management. They're based down there in the Big D, Dallas, Texas, but he's joining us here live in our Bloomberg Interactive Broker Studio. We appreciate that.